If you've been researching annuities, chances are you've already seen the debate. Some say they're amazing, others say they're a scam, but here's the truth. It all comes down to choosing the right type of annuity for the right season of life. In this video, I'm breaking down the difference between an income annuity and an accumulation annuity, who each one is best for, and how to avoid locking your money into the wrong contract. Because when you understand the why behind the product, you make smarter money moves. Let's start with income annuities. What are they? These are designed to do one thing really well: give you a guaranteed paycheck for life. Think of it like setting up your own personal pension. You give the insurance company a lump sum of money, and they promise to pay you a certain amount every month for the rest of your life. Sounds great, right? And it can be, especially if you're retired or about to retire and you just want that peace of mind you'll get a paycheck no matter what. But here's what most people don't know. That income guarantee, it comes with a fee, sometimes up to 1% or 2% per year. And depending on how it's structured, you may not even touch your original money or leave anything behind to the family. Some contracts start depleting your account the moment income begins. And once it hits zero, your income will continue, but there's no legacy value left. Now let's flip the coin. Accumulation annuities are focused on growth, but not income. There's usually no income rider, which means no extra fee, and you're not tied to a specific payout structure. These are perfect if you're still in your accumulation years, meaning you're working, you're saving, and you're building toward retirement. The goal here is to grow your money safely. You can link your growth to market indexes like the S&P 500, but your principal is protected. So even if the market does crash, you don't lose your base. Some of the top accumulation annuities right now have caps between 9, 11%, or participation rates over 60%. And most importantly, your money stays liquid, you avoid unnecessary fees, and you retain control. In addition, with the plan, you can still take income. It's called discretionary income, where you just take income from the interest that's grown within the account. So you're not actually touching your principal, preserving it for your legacy. Now, which one is right for you? Here's how I break it down for my clients. If you're already retired or you want to lock in income within 5 years, then an income annuity might make sense, but only if the numbers work. But if you're younger than 60 and still in that growth phase or don't necessarily need the extra income, and maybe you just want to preserve the money for passing to your kids or grandkids when you go, then having an income rider you don't need is like paying rent on a house you haven't even moved into yet. You're paying fees today for a benefit you might not need for 10 plus years, if at all. And then that fee starts eating into your growth every single year. So if you're not planning to turn on the income soon, don't pay for it. There are accumulation annuities that give you protection, liquidity, and better growth without the fee. Let me give you a real example because this is where people get confused. I had a client who had saved $400,000 in her old 401k. She was looking to protect whenever she retired. So we were looking at two different paths. Path one being the accumulation annuity. We looked at an accumulation annuity as an option because she already had Social Security income coming in, she had a pension set to pay her, so another income bucket wasn't a necessity. So with the accumulation annuity, her money still grows tax deferred and protected from the market, but now she has the flexibility to take discretionary income withdrawals. That means she's not locked into a paycheck schedule. She can pull interest or even principal when needed. The big advantage here is that there's flexibility with no fees. And at the end of the 10 years, whatever's left in the account is fully hers to walk away. The trade-off though is that the income isn't guaranteed for life. If the market doesn't perform and she overspends, the account can run down. Now, the second path we looked at was an income annuity. Here, the company guarantees a paycheck every single month for as long as she lives, even if the account value technically runs to zero. That peace of mind is powerful, but the flip side, you're paying a rider fee for that guaranteed, and at the end of the 10 years, the walkaway value is usually much lower because the income payments have been front loaded. So here's the comparison. With the accumulation annuity, keep that flexibility and potentially more value at the end, versus the income annuity, you give up some flexibility and pay a fee, but you lock in a lifetime of security. If you've been offered an annuity or you're just trying to understand what makes the most sense for your situation, you need to look at the strategy, not just the product. If you're focused on growth, make sure your money is actually set up to grow. And if you're looking for income, make sure you're not overpaying for guarantees you may not need. If you want help reviewing your options, click the link below to book a free strategy session with me. We'll review your goals and see exactly what situation makes sense for you. Talk soon.